Thank you, Katie, and thank you everyone for joining our webcast. This is Katie's version of social distancing. Um, not the norm for a baby boomer like me, but we'll we'll make the best of the situation that we have. Just a reminder, we're looking at February data. So the data that we're looking at is 2 months old, and a great deal has happened since then. So a lot of what I'm going to talk about maybe is more contemporary than the data that we're looking at. But let me begin by saying in February, we began from a good place. We actually saw production increase a little over 20,000 barrels a day, about 1.4% in terms of oil production. So that was a positive, 1.45 million barrels a day in February. Remarkably, natural gas production increased substantially more, 6.4% increase. And I apologize for some of you that got an early version of my director's cut. Somehow I managed to use 29 days in February for oil and used only 28 somewhere for a couple of data points. So gas production, 3.1 BCF a day, just slightly under the November 2019 production, which was our record. Gas capture, we hit 87%, which is a current year record, and just under 2.7 BCF a day, which is a new all-time high. So we are just on the cusp of achieving the gas capture goals of the Industrial Commission. As we had projected, we thought we might get there in February. We're certain that we're going to get there in our March production, and we'll talk a little bit more about that in a minute. The rig count has dropped dramatically. So we've lost about 40% of our drilling rigs in just 4 short weeks since March began, and since we started to see the COVID-19 thing begin to unfold and world demand plummet. And so we started the year at 55 drilling rigs. We're down to 34 drilling rigs. I think actually 33 are drilling oil and gas wells as we speak today. You can see in the waiting on completion numbers and the wells that are inactive numbers, the calm before the storm. And so what we're seeing is tremendous volume of applications for non-completed well waivers and inactive well waivers coming in the door. Next month, we're going to see massive increases in those numbers as the Industrial Commission has implemented its policy to allow industry to make business-based, financial-based decisions on cutting back production and shutting wells in. You can see in the completed wells that 3 consistent months all below revenue forecast. And you can see that on the Fort Berthold activity, that rigs are down, but production and well count is up, just as in the rest of the state. So what has happened over the last 4 weeks or so? Let's talk a little bit about that. We have seen, as I said, a 40% reduction in rig count. Industry is projecting that it could go as deep as 75%. Talking with the oil and gas operators, they're indicating more on the order of a 50% decrease April through June. A 50% decrease is going to land us in the upper 20s. A 75% decrease is going to land us in the upper teens. And so I think maybe the drilling companies are looking at it a bit more pessimistically than the operators are. The operators are doing everything they can to retain a core group of highly experienced drilling hands and drilling rigs so that when prices begin to recover, and they certainly will as they begin to recover in 21 and looking more forward into 2022, they'll have experienced drilling hands and be able to capture the efficiencies that they built into the drilling system over the last 3, 4, 5 years and not lose those. Also, we've seen a drop in frac crews. We started this whole thing with about 12 frac crews running. We currently have 8 to 10, 9 or so 25% decrease in frac crews. The discussion is that ultimately we're going to see, again, a 50% drop in terms of frac crews, likely to put us down around 5 or 6. Could go deeper than that. We'll see how long the price collapse lands. That, of course, is going to translate itself into not completed wells. If they continue to drill with 25 to 30 drilling rigs and cut back to 4 or 5 frac crews, then we're going to see rapid growth in the inventory of non-completed wells. So one of the things all of this translates into is job losses. We've posted a link there in the director's cut where on a weekly basis you can go to Job Service North Dakota and you can see the unemployment applications that have come in by sector. Pretty much at about 2,200 layoffs at this point, which occurred in the month of March. If we see the kind of reduction in drilling and fracking activity that the service companies are projecting, that could extend by maybe another 6,000 jobs with a total of somewhere between 8,000 and 8,500 job losses before things turn around and start to come back. And so we'll just have to watch that, but those are posted every Thursday and you can go there and have a look. New agreement announced Sunday by OPEC Plus. Certainly a good first step, and it seems to have kind of established a price floor, which has kept that West Texas Intermediate price above that $20 mark. It would have been worse had it not happened, but the projections that we're seeing, and I've seen some analyst projections, and what they're showing is that liquid fuel demand still hasn't bottomed out, that the demand for diesel, gasoline, jet fuel is going to continue to decline into probably the first half of May. That's a real serious situation. That means that we haven't seen the bottom of this market yet. Interesting that Chinese demand has begun to recover. So they've regained about half of what they lost during their major shutdown, their economic shutdown for the COVID virus. But they're not projecting to be back at pre-virus levels until the fourth quarter of this year. And when you look to the other G20 nations, they're seeing anywhere from 20 to 60% reduction in traffic volumes in terms of semis and automobiles and that sort of thing. Diesel demand has been stronger than gasoline demand because industry and the delivery of goods has sustained itself to some extent, but very little transportation across the Atlantic or Pacific Oceans. And so bunker fuel certainly way off, as is gasoline demand. So we're looking forward and thinking Saudi Arabia has indicated that if they're not in this all by themselves, they're perhaps willing to make deeper cuts, and we'll just have to keep an eye on that. Crude oil takeaway capacity, as if there wasn't enough bad news. When we look at our crude oil takeaway capacity, it looks okay for February, but we continue to see additional pressure. We still do not have a decision from PHMSA on the Washington State Senate bill. The U.S. Appeals Court has upheld the Swinomish Indian tribe's right to limit the number of unit trains that can cross their reservation in Washington. And now we have a decision in the DC District Court in that civil action between Standing Rock and the Corps of Engineers, stating that they have to do a full EIS, but in the meantime, they're taking a look at whether or not the current easement should remain in place or the DAPL pipeline might be shut down. All of those are severe problems, certainly, for our oil and gas industry. A little bit of bright news is a gas capture, much better. We're at 87% statewide, 87% for the Bakken, and for the non-Fort Berthold, 89%. So if we can get that northeastern segment of Fort Berthold up to where everybody else is, we'll be in compliance with Industrial Commission goals. Industrial Commission still intending to move forward with additional gas capture increases to the 91% level. Natural gas prices extremely weak, and a lot of pressure on our natural gas production to push towards flaring, but that's sort of a natural limiter on oil production. I just want to touch on what we've started doing kind of on a weekly basis. We have been polling pumpers and oil and gas operators around the state. And so they've been keeping us up to date on where production is and what they're doing with their wells. We ended the month of March with approximately 3,600 wells shut in. So as you can see from the February data, industry entered the month of March with over 16,000 wells operating. Ended the month of March with about 3,600 less wells operating is what our polling data indicates. And that translates to about 175,000 barrels a day that was shut in. In the 2 weeks since then, it would appear that roughly another 1,000 or so wells have been shut in, and that the shut-in production has increased to about 260,000 barrels a day. So roughly 4,600 wells shut in. Our best estimate is about 260,000 barrels a day shut in. So industry is rapidly taking advantage of the regulatory relief that the Industrial Commission offered and is making business decisions to reduce expenses, reduce production, and try to balance this market. As we speak, of course, today the Texas Railroad Commission is holding a telephonic hearing on the application of a couple of their producers to actually implement proration, which they haven't done since the 70s. And the Oklahoma Corporation Commission has received an application to look into proration and the amount of market that's available for Oklahoma production. They have already implemented proration of their natural gas production, and now they've received a petition to look at proration for their oil production. I can say that North Dakota hasn't looked seriously at this yet. We think that the market and the regulatory relief that we offered and the business decisions, the business model decisions, the market decisions that are being made are accomplishing the same thing, but in a much better way, in that each individual company is able to look at their debt load, their stockholders, their investors, their operating costs, and make those decisions on a well-by-well basis on, basically shutting in the most expensive wells and also the wells that are flaring the most gas. And so as it stands right now, we think that's the right approach, which is to offer that the very broad regulatory relief and allow our private companies to make those well-by-well decisions based on their financial situation. So we'll be monitoring what Saudi Arabia and OPEC do. We'll be monitoring what Texas and Oklahoma do. But as it stands right now, North Dakota is thinking that we've implemented the right regulatory process to respond to this market situation. and that by moving forward fairly aggressively on the flaring aspect, that will also incentivize our operators to reduce crude oil production and to stay in line with those gas capture goals. That was my prepared remarks, and so I think Katie is prepared to look through some questions and vocalize those, and we'll do our best to answer them. Thank you.
Lynn, are these all-time lows for rig count numbers, or can you speak on when it was last?
No, they're not all-time lows. And so we saw a rig count of 27 in 2015 when we had the previous price collapse. We're anticipating reaching the same kind of a level in the mid to upper 20s. We actually saw in the earlier price collapse, the 2008, 2009, we got down into the teens in terms of rig count. Now, lest I ever forget, 7 months after I took this job, which would have been in July of 98, so in February of 1999, North Dakota, for the first time in 50 years, went to 0 drilling rigs. And so I've seen it much, much worse, and may we never see anything like that again. But we were actually at 0 drilling rigs for a period of about 2 weeks in February of 1999.
Do you think, Lynn, that the OPEC agreements will begin to make a difference this year in the Bakken, or is that going to be a bit more of a long-term impact?
We hope that by the fourth quarter of this year, that OPEC agreement is going to make a serious difference. If you look at the supply and demand curve, the updated one that I included there on what's numbered as my page 2, Katie, do you have those graphs in your presentation?
Yep, just pulled up on the screen.
Okay, whatever page that's on. So if you look at that, you can see that by fourth quarter, though that OPEC reduction is going to result in less supply than demand. There's actually going to be more demand than production. And so that should begin to empty out storage and begin to make a difference in terms of prices and production activity. That will not immediately bring drilling rigs back, and hence the reason that we said oil price needs to be above $50 a barrel West Texas for 90 days before the policies that the commission implemented last month will kick out. But that will begin to put wells back on production, and I think the market forces will balance it. But it's not really going to make a significant difference in terms of oil and gas activity until probably the fourth quarter of this year.
Amy Sisk is asking, can you speak a little bit more on the improvement in the gas capture numbers, if that's being attributed to shut-ins of some of the wells, or if there's other factors that were involved?
So there's a couple of factors at play there. Thank you, Amy. But the main factor is that people are shutting in wells. And so we saw some additional gas infrastructure come online in December, January, February. And so some of the plants that were operating at less than 100% capacity actually saw gas throughput increase as some of the compression facilities and gathering facilities came on. But that was a less significant factor than with the beginnings of the price drop. Companies see natural gas revenue as a positive and a larger percentage of their revenue. And so the tendency has been, first of all, to shut in the very low marginal producers. But then secondly, the tranche has been wells that were flaring or flaring a significant percentage. So we are going to see improved gas capture numbers, we think, as a result of people making the decision to shut in wells that are flaring and far less completion of new wells.
Can you speak a little bit towards some of the regulatory relief that you had mentioned being given to operators, any flexibility or feedback on how the well waiver process is maybe being adopted?
Yeah, so let's start with inactive waivers. North Dakota rules and regulations place a well in inactive status as soon as it shows up with no production on our production records. So that's usually 2 months behind. And a well can only stay in that status for 12 months before it either has to be plugged or money has to be spent to return it to production or properly test the well and temporarily abandon it. The waiver allows that well to stay in a shut-in status for an extended period of time, basically up until West Texas crude prices exceed $50 a barrel for 90 days. What that does is it allows the operators to focus their cash flow on paying employees and maintaining jobs, but also on the more economic, more productive wells. And so it takes a lot of that marginal production. If something breaks on a well, it doesn't have to be repaired until crude prices recover. Non-completed waivers. So in North Dakota, a typical well now is costing between $7 and $7.5 million, but we use the $7 million number. $3 million of that is for drilling the well and preparing it for completion. So to drill and case the well is about $3 million. The completion itself is about $4 million. And so the commission has said, we're not going to make you complete those wells. Again, those wells either had to be put on production or plugged after 12 months in that non-completed status. This allows the companies to place them in non-completed waiver status until the price of crude oil recovers. And so it's going to allow them to continue to drill wells, to scale back on the most expensive part of the new well, which is the completion, and hopefully maintain that experienced drilling crew, some of those experienced drilling crews out there. Some of the companies are going to complete some wells in order to maintain cash flow, but we think offering them this relief allows them to make a business decision. What do they need for cash flow? What's the importance of an experienced frac crew to them? What's the importance of an experienced drilling crew to them? Can they hang on to 1 or 2 drilling rigs and continue to drill wells, especially in the core area where essentially the high IPs are a guarantee, and avoid that expense of completing the wells. So we're looking at a process that hopefully will maintain infrastructure and maintain jobs and allow them to make that as a business decision.
Could you, on a very high level, possibly address any revenue ramifications for state budget? Any idea of any revised revenue forecasts being contemplated at this point?
So Justin and I have provided our input on, as has Ron Ness from the industry perspective, have provided our input to Moody's, and they're in the process of running their model. They've got a series of several different projections that they're going to run, and probably here in a month or so, we're going to see those projections, those model results, and we're going to see budget guidelines for the state budget and for the state agencies. So they have, I know they've got something they call the moderate pandemic. They've got one they call the severe pandemic, and they've got one that's even lower than that. But I haven't seen the results of those. So they have taken these projections that we've talked about here, which clearly you can see that revenues have to go down. If we see production drop by 500, 600,000 barrels a day, if we see drilling activity decline by 50 to 75% and completion activity similarly, then there's a lot less sales tax. There is a lot less production and extraction tax, and a lot less income tax. So it's a pretty complicated model, but Moody's is in the process of running all those projections right now based on the data that I just gave you.
Got time, I think, for just one last question for Lynn. Does the state of North Dakota look at liquid fuel storage data? Is there a concern that oversupply, lower demand, combined with limited storage capacity is at play in the state production figures?
Absolutely. And so one of the things that is required to be reported to the Industrial Commission is crude oil storage facilities and crude oil transportation facilities. So what we're seeing is that our storage capacity at the head of the pipelines and at almost every still existing rail facility in the state, storage capacity is almost full. Downstream capacity is nearly full and looks like it could be full by the month of June. We've actually gotten inquiries from 2 companies this last week asking what do they need to do in terms of permitting and construction approvals from state agencies to build some significant storage capacity. And I'm talking about 300, 400, 500,000 barrel tank farms that they're looking at implementing fairly quickly. So we're close to filling storage capacity, and that is going to lead to rapid acceleration in the number of shut-in wells unless some storage capacity gets built. I think these folks see an opportunity to arbitrage, to purchase crude oil perhaps when North Dakota crude oil values, are sub $20, and within a year's time be able to turn around and sell that for well above $20. So we're starting to see a great deal of interest. That should warm the hearts of the people that build 400 barrel storage tanks and produce those here in North Dakota. Hopefully those jobs will stick around.
Perfect. Thank you, Lynn. I think we'll transfer over to Justin Kringstad with the North Dakota Pipeline Authority.
Stick around, I can come back on.
Perfect.
Excellent. Thanks, Katie. Can you hear me okay?
Yep, we can hear you great.
Perfect. I'll just wait for you to queue up those slides and we'll get moving along. Perfect. So we've got some additional data in from the state of or the portion of Eastern Montana, just over 55,000 barrels per day. In previous months, I've noted that Montana did have 1 active drilling rig on the western portion of the Williston Basin, and that drilling rig as of now is inactive. No active rigs as well in South Dakota, so we're expecting these production levels to continue to slowly go down and potentially even rapidly go down if the portions of Eastern Montana and South Dakota are also facing some of the shut-in challenges that we may be experiencing or are currently experiencing here in North Dakota. You can go to slide 3. And then just again, that quick update from North Dakota. As you heard from Lynn, we still don't have solid numbers from Eastern Montana to give us a sense of exactly where we're at in 2020, but just keep these numbers in mind as we move to the next slide and start talking about some of our transportation dynamics. So again, this is that monthly look at how the crude oil and natural gas month-to-month changes compare to previous monthly changes. Again, pretty consistent when you look at historic oil in the green or the upper portion of this graphic, and then in red below we have our natural gas gains. So again, definitely not record setting in either case, but pretty typical from what we were expecting coming out of some challenging weather time periods in December, January. February was relatively mild from a winter perspective. There weren't any major storm events, no real deep freezes, and so I don't think any of us were necessarily surprised to see that production increase in February. But things will certainly take a different turn here as we continue to move forward. So if you can go to the next slide, Katie. And so some minor fluctuations month to month when we look at the dynamics of pipe versus rail versus refining and trucking within the region itself. If you go to slide 6, Katie, we'll take a peek at the historic trend. And so we did see a month-to-month downtick in the pipeline export market share, and just a very small uptick in rail, and then a pretty noticeable uptick again in those volumes that are going north through the border ports and getting reported from the Federal Trade Commission. And so again, this is something that month in and month out, we don't have a whole lot of color exactly what strategies are being used when those barrels are being marketed north and south of the border. But again, according to those federal databases, that the volumes that we saw from January to February did grow in volumes going from North Dakota up into Canada. And the other metric that we always look at on this graphic is that blue dotted line, and that's that Brent WTI spread. And so February, it was right on that cusp. It's just over $5 per barrel. Again, $5 to $6 is that threshold where we start to see some market shifts as far as where flexible barrels will be marketed, whether that's on a pipeline system if there's space, or in the rail network. Again, depending upon what the conditions are in the coastal markets relative to the mid-continent pricing structure. So we go to slide 7, Katie. And so again, just a very small uptick in the crude by rail estimates, somewhere between 300,000 and 320,000 barrels per day being moved out of the region by rail. On slide 8, the destination for those barrels, again, this is coming from some of the EIA estimates. They're still looking at the east and west coasts, PAD 1 and PAD 5 being the top destination as of January. We saw a slight downtick in the amount of crude by rail heading to the Gulf Coast, and I think here on the next slide, when we look at the pricing of what was taking place in January, that helps paint the picture a little bit as well. So the West Coast, PAD 5, had the highest priced market in January, followed up by PAD 1, and then PAD 3 down in the Gulf Coast, substantially less or noticeably less than what PAD 1 and 5 were experiencing. So again, not surprised that we saw PAD 5 jump up as the highest rail market share, followed up by PAD 1, and then PAD 3 losing some market share to those other locations. On slide 10, we look at what pricing was doing today. Much different scenario. I was intending, I wanted to even include what this graphic looked like last month. A month ago, we were seeing Brent and WTI, or that Cushing price, almost hand in hand. There was less than $1 difference between Brent and WTI. Fast forward a month to where we're at today. Again, so much market fluctuations going on in every corner of the industry. And so one dynamic that's shifted substantially is this spread widening. So the WTI price has not really risen. It was very consistent with what it was a month ago, but we did see Brent strengthen, particularly with some of the news here in the last week or so of OPEC and OPEC plus countries cutting back some of their production levels. Here in the U.S., because we have such a high volume, refineries, there's so many dynamics at work right now. Refineries that are starting to curtail or curtail production runs. Some refineries looking at potentially shutting in, storage filling up, all these different dynamics taking place in the U.S. that we've got a completely different pricing scenario. The other thing I want to point out is down in the Gulf Coast, that LLS, Louisiana Light Sweet price, that is a negative 329 down in the Gulf to the Cushing price of 21.16. And so I can't remember a time that I've seen any type of substantial discount that we're seeing today. Typically that LLS price is at a pretty decent premium to what's taking place at Cushing. This has very significant ramifications for us in North Dakota, in that LLS is just one public indicator that you can look at for what is a light sweet barrel. How's it doing in the marketplace down in the Gulf Coast, especially when we've got our major pipeline connection with Dakota Access all the way to the Gulf. Right now, that LLS pricing in the upper teens down in the Gulf Coast at a discount to Cushing. And so any light sweet barrels coming in, whether it's from West Texas or Oklahoma or the Rockies or North Dakota, any light sweet barrel coming into the Gulf Coast right now is being discounted relative to Cushing. And so that's challenging from a marketing standpoint. Again, North Dakota has a substantial distance to market. And so we have these premiums that we pay in transportation to get to these marketplaces, and then to get to a market that's depressed is also very, very challenging. So we have seen some very steep discounts here in North Dakota as of recent. That makes it, again, even much more challenging, not only when the national and global markets are depressed, but even then when your local market gets depressed even further. Again, very, very challenging for folks in the industry to navigate through this. So if you go to the next slide, Katie. Again, this is just a quick update. I mentioned that we saw that both imports staying near record levels, and exports from North Dakota going north into Canada, those again at record levels, over 150,000 barrels per day. Again, not a lot of color of what's taking place there, but just providing it as reported and taking that into consideration with our market share estimates. So slide 12, taking a peek then at gas capture. As you heard Lynn say, 87% capture. When we look at the metrics of where that gas was being flared, we saw the blue piece of the pie, the amount of flare share perspective from zero sale wells, meaning no pipeline connection, that has stayed consistent January to February. Where we did see the decrease was in that orange piece. So again, the industry making sure that the wells that are connected, as new capacity was coming online, new compression, just freeing up space for those additional molecules from those wells to go to the gas plant, rather than a portion of them being diverted to the flare pit itself. On slide 13, then looking historically at what this has looked like. So if you, again, just follow the x-axis here, we've gone from early 2018 to the summer of 2019, where we were seeing consistent marching upwards of gas flaring percentages in the state. And so we're happy to continue to see from summer of 2019 down through February this decreasing trend. And as Lynn mentioned, I'm certainly in agreement that as we get into March and April, we're going to continue to see improvements on this. Not only because of the production dynamics that'll be taking place, but again, there was a tremendous amount of investment that's been made and put in the ground and in service in the last 6 months, that even if we did not have some of the production challenges that we have going forward, we would have still seen some substantial improvements in this space. So on slide 14, just taking a look, the one thing that, again, every month looking at how many well connections to gas sales were taking place, and then how many new wells were producing natural gas. In the month of February, this is, again, one of those months that we don't like what we're seeing, but if the industry can correct that going forward, and hopefully this was just an anomaly, we did see more wells producing natural gas than new wells selling gas. And so that may, again, have contributed to that piece of the pie where we didn't see any drop in the amount of gas flaring from unconnected wells. Again, in the month of February, we did not, the industry did not connect as many wells to natural gas service as new wells producing natural gas. So we'll keep an eye on this going forward. I think that it will become less and less challenging for the industry as we have less wells being completed, far more concentration of wells in the core area. So hopefully this will correct itself as we get out of the deeper winter months and into some more favorable construction season. On slide 15, again, this is just, you're going to see in a moment just a short-term natural gas production forecast. The EIA, at April 7th, they updated their short-term energy outlook. And so you can see that where we're at now in April, going forward, they're seeing several months of pricing around this $20 threshold for for WTI before we start seeing an increase in that level. And so on slide 16, using that price dynamic, you'll see a few different production scenarios. And so with not only the decrease in the number of wells being completed, but then also those considerations of how much production is being shut in around the state, we are anticipating a decrease in natural gas production. So this is a very challenging thing right now to forecast because, again, it's not something that historically we have really any good metrics or data to base it off of. And so we're trying, myself and other forecasters and the industry participants, again, trying to understand what this looks like from a production standpoint. Where does the production shift? Where does it concentrate going forward? The one thing you will notice is that with an expectation of decreased production, that gas capture target here at Q4 of 2020 is actually lower than current gas capture volumes. And so, again, reinforcing that point of, we're hopeful that in the near term, natural gas capture really gets itself in a very good position. And then the discussions with the industry is, again, once we get into this position and once we see activity start to return as the market improves, how does the industry stay in this position and continue to have North Dakota in a very good space when it comes to gas capture going forward. On the next slide, this is just a quick map of some of our major natural gas infrastructure. I was talking a few moments ago about some of the interesting challenges that the industry has regarding crude oil transportation and some of the market fluctuations. Some of the things that we're seeing take place on the natural gas space is, I'll start with Northern Border. That is our, in teal, that's North Dakota's major export pipeline option for the state. Right now, we're seeing decreased volumes, not only from North Dakota, but also from Canada coming down that system. And so for the first time in quite some time, we're seeing open space as that system leaves Glen Olin. So again, a lot of these fundamental truths that we used to have in the industry that, again, things like Northern Border will always be full. It'll either be full with Canadian gas or be full with Williston Basin gas. And today, in the current marketplace, that's no longer true. And so what does that mean from a gas quality perspective? We're seeing some of the heat issues on Northern Border. Those issues accelerate. Northern Border has been running above 1100 BTU here since this slowdown has started to occur. And so those dynamics of how much dry Canadian gas is going to be coming down versus hotter Williston Basin or Bakken gas getting on there, those are some of the near-term issues for the gas transmission industry. The other interesting dynamic, the WBI pipeline system north of Lake Sakakawea, so the river you can see in kind of that dark gray on this map, their system north of Lake Sakakawea for a number of months has been in capacity constraints. So every day shippers on that system get notices that that system is constrained. Here as of today, that constraint was lifted, again, indicating that they're seeing less gas volumes coming into their system, and that system, at least today, was no longer being deemed constrained. And so again, these are dynamics that we're trying to work out and understand what that means system-wide, and then also at a local scale when we're looking at plant capacity issues and constraints in the near term and long term as well. And then the other item I'll just quickly note, it's a good sign for us here in North Dakota that spring is in the air here in the last several weeks. WBI's gas storage down in the southwest corner of North Dakota and primarily in eastern Montana, you can see kind of a purple oval-shaped structure. That is the U.S.'s largest, from a capacity standpoint, gas storage field, and industry in the region has now shifted to gas injections. They've come out of that winter season, and we've now shifted here in the Williston Basin to gas injection season. So hopefully that means that we're turning a corner weather-wise, but we'll continue to watch that. Again, this natural gas space has a lot of moving parts as well. Right now with the crude price dynamics, what's happening in Canada, the U.S., and so I'll keep everyone up to date as well on some of these other trends that we're seeing that we may have otherwise not experienced. So with that, Katie, I'd be glad to answer any questions.
Thank you. Let me just pop in here and see what questions that we've got. One question we have, Justin, is related to storage facilities. Between storage facilities associated with North Dakota pipelines and rail facilities, any idea on how much total oil storage capacity exists in North Dakota?
I don't have a capacity total added up for that, so I apologize. I don't know of a public source right now that has that level of detail. And obviously there's filings out there and things of what specific, Dakota Access at the Public Service Commission or Enbridge or some of these other participants, but some of the smaller local field storage levels, that I don't have a good total for you at this point.
No problem. How about if the Strategic Petroleum Reserve were to take in Bakken crude in the near future, how might North Dakota Oil get there? Is that a possibility through DAPL and other pipelines, or would that be via rail or other transportation sources?
I don't know the specific logistics once you get down south to get into that storage reserve. I assume that it's very well connected to the major market points, which North Dakota is well connected now. Once you get to the Gulf Coast or get to Cushing, there are quite a few options for crude oil to be shuffled around and moved to where it's required. So that's a great question. I don't have the exact route of how that would get into the Strategic Petroleum Reserve, should that be an option for the Bakken crude grade. But that's something I'll look into. That's a good question.
Thanks, Justin. That's all the questions that I do have that have come here into the chat room. I might have a couple that'll come in for Lynn if Lynn wants to join us again. Lynn had mentioned that some companies are considering building storage in North Dakota. What does that process look, and this may be also a question for Justin, but what does that process look like? How quickly could storage be built between permitting approvals to usage?
So we've done some research and trying to assist these companies. They're looking at building large tank farms made up mostly of off-the-shelf 400-barrel tanks. They would put them on land that they currently own. In one case, a company owns and operates a oilfield waste treating plant, and they've got spare acreage associated with that. In the other case, it's a disposal well, and they've got spare land associated with that. So they're looking at building a large tank farm, grouping the tanks so that they can be safely contained in case there was a leak or something like that. We've been asking questions about what kind of site security they would have and that sort of thing. They're going to have to talk to North Dakota Insurance Commissioner because there's a fee for crude oil storage, above ground storage tanks. They're going to have to talk to the fire marshal because there's a permitting process there, and they've got to be in compliance with the fire standards. And then they're going to have to talk to Department of Environmental Quality to make sure that any VOCs or tank vapors are properly captured and dealt with. So they've got a series of permits they have to go through along with the construction and that sort of thing. But they think within 4 to 6 weeks, they could have a tank farm up and running if they hit the ground now, and of course with construction season beginning. So in one case, it's a tank farm of slightly over 300,000 barrels that they're looking at. And they think maybe within 6 weeks, they could have that up and begin to store crude oil.
Thank you, Lynn. How about the response in the field from companies? This is actually related to COVID-19. Have we gotten feedback on what some of those companies might be doing? How our field inspectors are still able to go out on site? Can you speak a little bit to how they're doing their daily work?
Sure. So most of the oil field operates with a pretty minimal people on site. And so for the most part, not a big issue, but there are some facilities that are manned 24/7. And then of course there are drilling rigs and frac crews. All of the drilling rigs have implemented health checks. And so in order to get on the site, you've got to answer a series of health related questions, as well as have your temperature taken. And of course, they are considered essential employees, so they're exempt from the 14-day come into the state quarantine. But again, every frac crew, every drilling rig has implemented health checks for people going on and off that site. We've had one drilling rig report to us that they had COVID-19 infections as quickly as they could. They sent both rig crews home and replaced them with fresh in-state employees. And so, that's bound to happen here and there. But everybody who's got multiple people on site, one of the other things we've offered in terms of regulatory relief is meter proving. That's sort of a people getting awfully close together inside a building situation. And so we're granting some short-term variances in terms of extending meter proving periods of time to try to get through the time of shelter at home.
A question related, do you know if the state is being involved in any way or engaging in the pending decision by the judge in regards to vacating easements for DAPL?
It's my understanding that the state of North Dakota is going to file amicus briefs in favor of keeping that pipeline in operation while the Corps of Engineers full EIS is conducted. Those briefs are due, I believe, the 24th of this month. It's either the 24th or 29th. I misplaced my note here, but somewhere in that last week of April, those briefs are due at the DC Circuit Court. But it's my understanding that the state of North Dakota is going to submit amicus briefs in favor of keeping the pipeline in operation.
We've got time for one last question here from Luke Johnson. After Whiting's bankruptcy last week, are we expecting to see more Chapter 11s from companies in North Dakota? And then maybe briefly, just because of questions we've gotten, explaining that slight difference between Chapter 11 and a Chapter 7 bankruptcy.
Mm-hmm. Yeah, so we do have a number of companies that are distressed, and so fully anticipating that we could have a handful of those type of bankruptcies. Some of our operators operate marginal legacy vertical production, and that's particularly distressed, but some of our Bakken operators are financially distressed too. So Chapter 11, of course, is a reorganization in which a company gets the opportunity, the time, the relief to work with its creditors and its stockholders and its bondholders to work out a plan to repay at least a portion of that indebtedness. And so they're not forced into a liquidation situation, and they're able to kind of step back from it and work together as a team on a plan. That's the sort of thing that we're anticipating. A Chapter 7 bankruptcy, of course, we've seen some of those in the last few years, and that's a complete liquidation. Most of those cases, though, the assets in North Dakota have outweighed the liabilities, and so the bankruptcy court has turned those assets and liabilities over to a new company. We've required substantial bonding from those new companies to protect the state from the possible outcome of that. But yeah, we're expecting a handful or so more of those. That's another reason that we've taken the approach we've taken with the regulatory relief as opposed to proration. Proration puts everybody in the same box, treats everybody kind of the same on a percentage basis. The state is making well by well production decisions, and so it ties the hands of the bondholders and the bankers and the debt holders, and they really can't do anything. Whereas the relief that we have offered allows each company to take a look at their business and work out a plan with their debtors or their debt holders that fits their company, without the state of North Dakota intervening and disrupting that whole process. Every company has a different situation.
Thanks, Lynn. I think that's all the questions that we have for today. Thanks for folks joining us virtually. Just a reminder that our next director's cut will take place on May 15th at 2 p.m. Central Time, unless otherwise posted on our website underneath the Information Center. And also just a quick reminder that to let others know that the director's cut is available on our website. It's also available where you can watch back the recording on YouTube, and then we're also posting it on Apple Podcast. So you can get to all of those from the Oil and Gas Division's website. And if you have any other questions, you can certainly always just contact the Oil and Gas Division, and we are happy to help you out. Thanks for joining.